Nigeria's financial markets are entering a decisive stretch. The MPC meeting is around the corner. A major bond auction is set for Monday. Q4 GDP data is expected, and developments around the NNPC remittances and FX liquidity are reshaping macro conversations. So investors are trying to position ahead of the policy meeting. They're trying to balance the moderating inflation, stable but managed FX conditions, and shifting liquidity dynamics. So in this episode, we connect the dots across bonds, equities, monetary policy, and fiscal signals. And more importantly, we're going to be examining what all this means for positioning in the weeks ahead. So if you care about equities, you care about bonds, you care about yields, Naira, FX, and the NGX, you care about Nigeria economy and what is coming up or where we are headed next, this is a conversation you want to stay with. So joining me to provide more clarity on this topic is Dipo Ajayi. Dipo is head of fixed income and vice president at Chapel Hill Durham. He brings to this conversation deep insights into the Nigeria's bonds and equities market, liquidity, and FX condition, and what investors should be watching ahead. So, Dipo, it's great to have you again on the edge.
Hello, good day, Dr. Tony Okafo. It's a privilege to be on the program once again.
Right, always my pleasure having you here, Dipo. And welcome, everyone. Welcome to our viewers. If you are new to this channel, this is where to be. Here we go beyond the headlines. We break down the financial markets, bonds, equities, policy directions, and the macro forces shaping investor outcomes. So please like this video, subscribe to the channel, and hit the notification bell so that you can always be notified when a new episode is uploaded. So welcome, everyone. All right, so Dipo, I think let's start off by looking at what happened in the market this outgoing week. The NGX index closed around 194,990 points, and roughly about 6 to 7% up for the week. So what drove the market? What drove this bullish momentum in equities, especially with sectors like the oil and gas, banking, and the industrial giants? So what drove the market in the past week?
Well, thank you very much for that. You understand that the current time is more like is the earnings season, and based on the result that has been released to the market, we've seen quite a number of great performances by most results released in the market, both the audited and the unaudited results. And so markets are currently positioned to actually take advantage of better results that we actually further expecting into the market. And beyond that as well, we understand that Nigeria market is heavily on the price. We have said this a long time, but I think there's a bit of more clarity in that direction, and I guess that's one of the reasons why we've been enjoying a great level of inflow of funds from foreign investors into the economy, and beyond the OMO markets. Also, the bond market is also enjoying same, and also the equity market. So some of the activity we are seeing in that sector is basically both the foreign guys and also the local guy trying to actually position and take advantage of the performance of most of these companies during this earnings season. And we have quite a number of great performances this week. Even in the cement sector, we have the Lafarge. Lafarge, and I guess one of the reasons why we've been seeing a bit of more interest in Lafarge could be traced to the announcement that was made about the expansion in two of their operating plants. And so, of course, a lot of people have been waiting for when Lafarge will further expand their capacity. Because when you look at the fundamentals around Nigeria, I think the current government is more about infrastructure. And based on the model that we are currently operating, that when you look at road construction across the country, it's more like the cement and more like the paved method. And when you look at that, it simply means that those who will benefit from that will simply be the three major players in that sector, which is Dangote, Boa, and also Lafarge. So Lafarge is already preparing
Dangote
themselves.
is everywhere.
So yeah, and don't forget that we say this a lot, that to make the money you have to solve a problem, and that's exactly why they actually. So now Lafarge also has actually decided to actually expand their capacity. Of course, before now, Dangote, Boa, they have idle capacity they can quickly use to actually maximize improve demand. So what Lafarge also trying to do is to actually join the bandwagon so as to have also expanded capacity so that they'll be able to take advantage of that. And also beyond that, also don't forget the banking sector. Most of them are fully recapitalized, and also you expect them to sweat the capital better. And a lot of them are still they've not been re-rated. You see names like Access Bank, you see names like Zenith, Fidelity, FCMB, and the likes. So you expect to see more like improved activity in some of these names, and also looking at the expected performance that you expect them to actually post. These are some of the things that are actually driving market also in that segment. And also the news.
Sorry, Dipo, sorry for cutting your train of thought. What I'm hearing you say is that in addition to the earnings reports being released, investors are beginning to position because these banks now have more capital that they can play with. So beyond these earnings seasons, investors are actually positioning for the long term.
Exactly. So it's just like let's look at it from this perspective. Before now, imagine a bank that used to have maybe like a 200 million billion capital, and the bank is actually posting maybe like a 3 trillion worth of top line. And now that such bank has recapitalized, and don't also forget that most of these banks, they are now flying lighter now because of the loads the central bank has mandated most of them to actually share some of the loads they are carrying, and this will actually help them to actually fly lighter. So we expect that to actually affect their business positively, and that's another reason why most of them are actually playing in that sector. And also when you look at also the telecom sector as well, MTN is doing greatly. If you look between last year, early last year, when MTN was still sitting on negative shareholders fund, a lot of us were pushing that if you have fund, buy MTN. And I've used premise on when you look at the operational activity, this is more like a cash pay. They are actually minting cash in that sector because you look at you have to make a call, you need to use data, and these are key things that. And a lot of them have been able to actually take advantage of that. And also, there are news around the acquisition on the back of MTN Global last week also.
The
That's also
IHS TAR. Is that what you're talking about?
Yeah.
That's about $6.2 billion.
Exactly. Okay. So when you look at that as well, it means good to MTN. And so a lot of news that we've seen in the market is more like positive news all around. When you look at the macro side, everything seems as if we have actually negotiated that dangerous
bad.
You understand? So
we will talk more about those macros when we talk about our expectations for the MPC. So let's still stay with you on the markets. On the bond side, yields have been compressing. Okay. Benchmark FGM bonds are trading around 16.5 with good liquidity in the system. So what's your read on the fixed income market this week? And were there any notable shifts around demand from investors' behavior? Were there any notable shifts from local or foreign investors that you noticed?
Well, I won't say there's any shift. The central bank was in the market twice this week, issuing normal bills. And but what very concerning around that was the tenor. The first day they issued 8 days bill, and also a 99-day bill, and also the next day they issue another 7-day bill and a 101-day bill. And when you look at the short tenored instrument, you question yourself, what does the central bank want to achieve with actually issuing 8-day bill? And but I think it's very strategic because don't forget next week is NPC meeting, and the central bank on their part as well. And they are trying to actually take liquidity out to actually allow the liquidity to come back to the system next week. And if we have seen their method of managing liquidity, we've seen a situation whereby they have been a bit less aggressive in the mop-up strategy around mopping liquidity from the market, and that actually helped market activity. But when market noticed the tenor that the central bank actually offered, that actually reignited that aggressive interest in the treasury bill space. At the beginning of the week, treasury bills, long-dated instrument, that's more like the 4th of February bills, opened the market around 16%. And by the midweek, this instrument already trading around 15.5. And that's not all connected to the fact that the posture of the central bank actually sent a signal to the market that the interest rate expectation is that in the long run, rates will drop. Because when you continue to actually see more like the long dated trade lower than the short dated, or more, it's more like a signal telling you that you expect rate to actually drop in the future, and that's that. And we also saw that play out directly live at the auction, where the 182-day paper actually cleared above the 1-year paper. Of course, it was surprising for those people that actually participated in the market auction. The 91-day closed at 1580. The 364-day closed at 1590, and the 182-day closed at 1665. Of course, a lot of people look at it from the angle of, wow, that is actually
we're having a humped yield curve.
Exactly. when you see more like an hump discount rate at that auction. And also the activity at the treasury bills also impacted what we noticed at the bond space as well, as market interest in the belly of the curve actually came out more aggressive during the week. We saw interest on 31, 33, 34, 30, 35, 32, all the 30s, as in all the instruments around 30 were on.
Are you still seeing interest on those bonds that are going to be issued on the at the auction? And I also want to get your take. Is the the way the central bank has been handling this OMO, do you, in your estimation, think it is achieving the desired results?
Well, it depends on the result that the central bank wants to achieve. Firstly, the result could be to further actually attract foreign inflow effects into the market beyond actually mopping liquidity from the system. But when you want to talk about maybe to actually mop liquidity, then one way or the other, I think what the method is doing is that one way or the other, you are using one stone to actually kill two birds. Because what you are trying to do is lure foreign investors in the market, and at the same time see as much liquidity that you can actually take out from that market, applying that method. So one way or the other, I think he has worked the magic, because when you see what's happening in the FX market, you will understand that truly it has worked the magic. But the flip side of it is that what most of these international financial institutions are actually talking about, that we need to now move beyond actually using OMO to actually attract FX in the market into a level where you can now start using the OMO to actually directly mop the liquidity in the system.
As a tool for money supply control.
Yeah, exactly. And normally OMO is not supposed to be a long-dated instrument because you expect OMO to be like a 60-day, a 70-day bill. Just for short-term liquidity management. So, and I think that is what the IMF and the World Bank is currently speaking to the ear of the government currently. And one good thing about the current government is that they listen, and when they listen, they try to actually act on good suggestions.
So what you are saying is that we might be seeing OMO now, I mean, the local players in the market now having access or having opportunity to purchase those OMOs soon. Okay.
I
Yes,
think
go ahead,
we
please.
need to get to that level because before now, OMO is not secluded for foreign investors and only banks. It used to be more like a market that's open for everyone. So it simply means that if I'm not buying automobiles, if I'm not buying NTB, I can decide to buy automobile. It was at the point where we are actually doing more of capital control. That's at that point where we actually now secluded OMO to be for foreign investors and only the banks as a player in that segment. So I think that we are getting to a level because what the current central bank has been doing more like a free market strategy. If you see what has happened in the FX market, of course, you will agree with me. As BDC can also participate in the FM window as you speak currently. So in the same vein, I think that we'll get to a level where an individual can actually now participate in the OMO window. So what we now see is that the gap between the OMO rate and also the NTB rate will further narrow.
Okay, yeah, I mean the way the OMO is handled, I think it's obviously one of those vestige of the challenges that we had during the FS market that is still left, that has not been totally, brought back to actually the way it's supposed to be used, which is in managing liquidity, having all players in the market have access. And that's the only way they can actually mop up liquidity or control liquidity because, as you've said, if it is only available to foreign players, then foreign players inflow USD into the economy, which might have part of the desired effect, but in totality would not achieve all the outcome that is desired. So, therefore, let's turn into the major one, happening next week. We'll have two major events actually next week, but let's talk about the MPC meeting first. So the MPC meeting is scheduled for February 23rd and 24th. So analysts are divided, obviously, and we are going to be hearing your take on it. So some are expecting a hold to keep fighting inflation, even though inflation we now have inflation, I think, about 15.1%, while others are looking at the possibility of a 50 to 100 basis point cut due to disinflation. I mentioned headline inflation is about 15.1. We also have stronger reserves now and Naira stability. So what's your base case for the MPC outcome, and what data points will you be looking at, or what data points do you think the committee will be watching most closely?
Well, if you look at the MPC meeting that holding next week, and that will be on Monday and Tuesday. Before now, I'm on the divide side of the divide where I feel that it should be more like a hold, and my view is premised on the fact that there's every tendency we likely see inflation in the month of January actually inch to around 18% levels. But based
that
on the
didn't
result
happen.
Exactly, based on what was released by the NBS, of course, it's pretty clear that inflation printed 15.1 in the month of January, and we saw deflation on the food and even in core inflation, and that's one of the things that's now moved me from the divide where I see it before now that they will likely be hold. So I think that there will likely be a rate cut, and of course, my view is premised on the fact that currently inflation is at 15.1. Monetary policy rate is currently at 27%. And for me,
12% higher.
That's about 1,200 basis points from where the inflation is currently sitting. And at the same time, you don't forget that The policy rate is what banks used in actually benchmarking their lending to the real sector. And so when you look at that from that perspective, and you want to see an economy that wants to grow, and you want to see an economy that want to actually push and actually create employment, I think it's high time we start doing something and take advantage of that gap. 1,200 basis points between inflation rate and the monetary policy, I think that is actually huge. Because for me, I think we need to be very careful and not to render the monetary policy rate redundant. Because when you look at where interest rates is actually printing, you look at the treasury bills, a 1-year treasury is around 19%. Look at bonds currently trading around 16%. And you now look at a monetary policy rate and at 27%. And I think if you are not very careful, we'll get to a level where the monetary policy rate will not make meaning to the market again, because when you see that huge disparity between where it's trading and where it's currently. So it's on the back of that I feel that the monetary policy guys need to actually do something around the policy rate. 27%. I won't be surprised if I see more like a 200 basis points rate cut for a start at the beginning of this year. So a 200 basis point would take monetary policy rate to 25%. And at 25%, of course, it simply means that you are taking more like a whopping 200 basis points from the cost of borrowing on the part of companies and parastatals that are actually currently borrowing from banks. So that's one way or the other could actually help the risk sector, and which I feel that should be the motive. Because and with a 200 basis point, it's not in any way putting pressure on inflation. Because currently inflation is at 15.1. Inflation is on a downward trend, and when you look at the way we've been moving, so I think I will be on the side of those who actually expect more like a rate cut, considering that we don't have reason to actually still hold rates.
Okay, so I perfectly understand your direction. I mean, your thought process. But what about those who argue that we should not be too quick to begin to unwind those tight monetary policies because of the gains that we are beginning to record on FX? And that if we begin to unwind those policies, that could begin to affect the stability of the Naira.
Dr. Tony, if you look at it critically, the monetary policy rate is inconsequential, because that is not even what we are using to actually attract foreign investors into our market. What we are currently using is return on investment, like the OMO return, like the treasury bill return, like the return on bond, not the monetary policy rate. So, and that's why I said we have to be very careful not to actually get to a level where, because we have been here in the past, during the past dispensation of the central bank, we got to a level that the monetary policy rate does not make any sense to the market. Because if you remember vividly, inflation was over the monetary policy rate, and we kept the rate at 14%. So you get to a level that is not even serving purpose. So, and that is, we don't want to now flip it at this other end and now put rates so much higher than inflation that is not making any sense. Even if you take the policy rate to 20%, I will still tell you that it's not making any impact, because the foreign investors, what is actually bringing them to the market is the rate at which they get from the investment. And when you're looking at investment, you're looking at the OMO window, you are looking at the equity window, you are looking at the treasury window, you are looking at the bond window. That is more like the real catalyst that's actually driving it and actually bringing them to the market. Nothing that has to do with the monetary policy rate. The monetary policy rate, I think that holding it is more like punishing the people actually operating the real sector, because they are the one that's being benchmarked. They are the one that banks benchmark their lending around the monetary policy rates. So that's one of the reasons where I feel that we need to actually do something around that, so that one way or the other, everyone can actually benefit from the new economy.
Yeah, and I can assure you that we'll all be glued and everyone will be watching what the outcome of that meeting is going to be. I also believe that it's going to be feisty. That a lot of people, I expect a lot of the members of the committee to really be watching those data, especially as it pertains to accessibility of funds to the real sector. But again, we'll have another major event taking place tomorrow. On Monday. which is the DMO's bond auction. So you're offering, I think, about 800 billion Naira across different tenors. So what are your expectations for subscription levels, outcome, and how might strong foreign portfolio inflows play into it?
You see, currently now, Nigeria is more like the signature of all eyes. And I've sat down to think about it, why they're studying aggressive interest in the Nigerian market. And what came to mind is that I remove her from the FATF gray list that could also play a great role in this regard, because simply means that funds cannot flow directly into the Nigerian market so easily because of our removal from that list. And because when you look at currently where we are seated now, you see yield currently still around 16%. And that is actually very sizable for a foreign guy that actually looking at our market. We've seen an improvement in Naira, because when you look at the performance of Naira this year alone, I'm sure those people that made that call to actually rush into our market when rate was 1,600. Of course, they will look back and say, wow, they've actually made one of the best decisions, because beyond actually enjoying return on assets, they're also enjoying instead on the
exchange rate
currency.
gain.
Yeah, so they're also enjoying that. And if the direction sounds more like the currency may continue to actually gain throughout the year, because when you hear the richest man in Africa actually make postulating that the rates will actually trade 1,100, of course, you one way or the other need to take heed from that, because currently Dangote refinery is actually operating a full capacity of 650,000 barrels per day. And also, they've also signed a lot of documents around actually expanding the capacity of that refinery. So I want to imagine a Dangote refinery are now producing 1,000,000 barrels per day. You can see what will be the effect on the reserve, and how that will actually further help strengthen the Naira. So when you look at it from that perspective, it means that Naira looks more like the winning guy currently, and may actually continue in that stride, considering the policy of the government. And if that is the take, of course, it means that we'll continue to see inflow of investment into our market. And we expect that to actually affect this forthcoming bond auction aggressively. When you look at the last NTB auction, even on the 364-day paper, we actually had subscription of over 4 trillion on that on 364-day paper. So it gives you an idea of the level of interest that we are currently seeing in the market. So we won't be surprised if at the auction, and despite the fact that the DMO is actually offering 800 billion across these three maturity, we won't be surprised if we see subscription close to 2 trillion on all this maturity altogether. And for us, we feel that this instrument will print around 16% levels. One of the reasons why we feel that the market is currently trading around 16 dots around most of these belly of the curve instruments. And so we feel that there's every tendency the market may actually want to get a premium for actually buying from the primary market, which may actually lead to market actually pushing for between a 15 to 20 basis point at the auction. So we won't be surprised to see a 16.2 levels. So our call is between 16 to 16.2 level for all the three maturity at the auction.
All right. Thank you. We'll be watching out for the outcome of that bond auction tomorrow. So, Dipo, let's talk about the GDP figures now. I know that is being anticipated. Do you have any ideas of when this is going to be out?
Well, GDP figure, we normally get to see GDP figure towards the end of February to March, because that's more like about towards the end of Q1 in the new year. So the GDP figure, we're expecting to see it between the end of February to more like a mid of March.
Okay, so we've seen strong GDP figures for 2025 overall, even though we're expecting that Q4. Q3, I think, printed, I think, 3.98. So the full year that we're expecting, it could be around 3.9. Some are projecting it could get to maybe about 4% based on driven by higher oil production rebounds and in services. So we expect Q data to be out soon. What do you anticipate that the Q4 GDP figure would look like? And
I think
are there sectors you think would be driving this growth?
for me, I would pick more like a 4% levels, and because when you're seeing what we printed in Q1, Q2, and Q3, and also the last quarter of the year, also normally witness a bit of activity considering the festive period and every other thing. So we feel that the Q4 figure could actually push rate to actually average. A 4% for the year 2025. And if you ask me what sector should I look at for, I will look at for the oil and gas sector because we've been seeing a bit of reform in that sector, and that has actually improved the level of activity that we are seeing in that sector in terms of volume that we're being produced and other things around that. And beyond the oil and gas sector also. And I also think that the service sector will play a major role like he has always done in the past. So we will look at for the also for the service sector to also be a great contributor to actually pushing the figure out on a better platform as well. I think the agricultural sector would have been a very good one, and I'm sure we discussed this on this show before, where I said if something is having close to about 24% of the basket. You imagine if he actually performed very well, how he can actually push the whole basket, and that's why
I know you keep harping on this agriculture sector because of its immense potential.
Yeah, so and that's one of the reasons why I feel that if we can actually get that right, we could likely actually push our GDP figures to close to a double digit, considering what the potential that we actually have in that sector, and even beyond. The GTB contributions. Don't also forget that would be more like a very good strategy to diversify our FX revenue generating capacity because we can also leverage on that to actually diversify the oil sector FX revenue. So I also think the banking sector also is also another sector that we need to actually look at for. These are big giants as we speak currently. You barely can call anyone, any of them, just an ordinary bank now. Most of these banks are actually going in now for tier 1 license. Most of them are sitting on the 500 billion capital. So it gives an idea, because what it would do is that, don't forget, one of the reasons why the government actually pushed for the recapitalization is also on the ground that if you actually want to do a $1 trillion dollar economy, of course, the banking sector needs to actually be firing on a great cylinder. And and that's one of the reasons why that is done. So it simply means that we want to see how they are much ready, what has been the initial part or contribution in the first year of this recapitalization, so that we'll see whether we are already on the right track around that. So for me, all in all, I expect to see more like a 4% GDP.
Okay. I think you are almost on par with what other analysts have been putting out as the expected GDP figure for Q4. Now, you also talked about FX revenue and stability. And one thing that happened last week is the presidential order, which is, I think, tag order 9. So the president recently signed that executive order 9, mandating direct remittance of all oil and gas revenues, taxes, royalties, profit on oil to the federation account. That's suspending that NNPC's 30% management fee and frontier exploration deductions. I know you've been monitoring this. What does this mean especially talking about revenue or addressing those revenue leakages that the president talked about? What does that mean for Nigeria's capacity to especially meet this 2026 budget that's about 54 trillion and the amount of deficits that we have?
Well, Dr. Tony, I think this is one time that both those who are pro the president and anti-president are actually coming together to actually speak one language in this regard. And we when we get to that point, it simply means that everyone felt that that's one of the best decisions that would have come now from this present government. Before now, like you actually highlighted, NNPC actually charges 30% management fee and also the 30% also for frontier exploration fund as well. And what is the motive? The motive is that to actually separate this fund and what do you use the fund for? So you use it to actually to actually prospect oil. So it simply means that you want to go and check around what state has the likelihood to actually bring
oil.
new oil discovery. And this is actually a fund that you actually expend in that regard. But what the government is currently saying is that currently we are sitting on huge reserve of oil. Why are we keeping money? Why are you actually separating money in that regard? And it makes a lot of sense because just like what you highlighted currently, the budget is around 56 trillion. And when you look at the deficit, this deficit is close to about 40% of the budget. So what are we doing? Why should we be borrowing when we are actually sitting on idle cash? So what do we need to do? And that's exactly what the president has done. What the president has done is to actually free up this cash. The cash goes directly to the federation account, and from the federation account, the funds can now go to the three tiers of government. And from the three tiers of government, we expect them to now utilize this fund to actually utilize this fund to actually better the life of Nigeria. And at the same time, what this will also do is that reduce the reason for borrowing on the part of the government. And what the government is trying to actually tell the NNPC is that more like you are now a private company, so you need to behave like one. So instead of actually reserving funds, why can't you just go and look for investors to actually invest in that regard? Of course, before you actually call an investor to come and sit on the table, you would have been close to about 70% sure that there's every likelihood that there will actually be oil in the region that you actually prospecting. And so when you look at it from that perspective, it means that the day of just sitting down on fund, because you can just decide that we have a lot of fund in this account, can we just go to Borno to go and check if there's oil? Can we go to, because the fund is there, but now you need to actually get to bring investors on ground to sit down.
Is there to waste.
Exactly. So and that's one of the reasons why I actually support the president in this regard, because what this will do is what I just mentioned earlier on. It gives more fun to the government to actually play with. It gives more fun to government to actually better the life of Nigeria. It gives more fun for government to actually embark on aggressive infrastructural drive, reform drive, and which at the end of the day will actually better the life of Nigerians, will create more jobs, will create an enabling environment for business to actually thrive. And at the end of the day, will actually bring Nigeria to the level that we would have actually expected.
Yeah, I agree with you. Some reports, before you'll be surprised, some reports are putting this amount in the last 10 years to be over 200 trillion naira, which is close to about 60% of Nigeria's GDP. So that's
more like our 4 years budget.
That's a humongous amount of money. So one wonders why it took all this while for this executive order or for this reform to actually be put in place. And I think I saw the Minister of State for Finance actually issue additional instruments on the modalities for implementing this executive order. So we'll really watch out and we'll follow this and see how it pans out. So from the FX perspective now, how could this boost inflows to the reserves, reduce fiscal strain, and support Naira stability? How do you see this all playing out?
So what this simply means is that the oil revenue is dollar denominated. So it means that if you are keeping like a 30%, it simply means that you are keeping a 30% in dollar funds. And so now that this fund is going directly to the Federation Reserve, so it simply means that we have more FX inflow into the economy. So it simply means that we'll like to see a better level of accretion on our reserve. It simply means that the central bank will have more firepower to actually meet the demand of companies looking to actually import machineries, meet the need of people at the retail segment of the market as well. So it simply means that we'll likely see the joy of seeing this Naira stability to actually live longer beyond what a lot of people have actually believed. Because what it simply means is that because we're currently seeing more inflow of FX into the market. So for me, I think it's actually a very good one because it will further help the performance of our currency.
Are there any short-term risks that you anticipate, like potential investor concerns or job losses in the oil sector?
Well, I think that I don't think that should be anything sizable to be compared to the benefit that we accrue to Nigeria. Because when you look at the cost benefit analysis, even if the cost is that some segment of people may likely need to actually lose their job, but you can't compare it to the benefit that actually accrue to the whole of Nigeria and the whole overall economy. So the fact that we've been doing something wrong does not mean that we need to continue in that life. If we have woken up, there's one thing they say that whenever you wake up is your morning. So we are awake now, and this is our morning, and we need to actually work in that manner.
Okay, nice one, before. Right, everyone, you are still on the edge. If you are joining this channel for the first time, please like this video, subscribe. We're breaking down beyond the headlines, providing you market insight, right? And I'm still with Dipo Ajayi. Dipo Ajayi is a top investment analyst here monitoring the Nigerian capital market. Dipo, thank you for still being with me. So let's talk about the recent developments in the FX markets. The CBN has now allowed licensed BDC operators, I think about 82 of them now, to buy $150,000 weekly at market rates to improve the retail FX liquidity. So what has been the impact, or what's been the impact of this on the parallel market premium, the Naira value, and the overall access to for funds for end users?
I think it has been a great year all around. When you look at between January and now, in the whole segment of Nigerian economy, it's been all round positive news coming out. Before now, what we've seen more like that huge gap between the official window and the parallel window, and one of the reasons why that happened was because we only have 82 BDC currently as we speak. The license for BDC is now 2 billion for tier 1, 500 million for tier 2. What tier 1 would allow you to, you will have branches across all the states of Nigeria, but the tier 2, I think, is just for three states in Nigeria. So when you look at this and compare to where we were coming from, where we used to have 6,000 BDC. So before now, it means that on a weekly basis, there's allocation of $15,000 to 6,000 BDC to actually cater for the retail segment of the market. And now we are just allocating only 15,000 to 82,000 BDC. And that's actually led to the gap between the official window and the parallel window.
You mean 150,000?
Yeah. No, before now it was 15,000 to them.
Yeah.
So and that's what led to the gap because there's not enough supply to that segment of the market. So what the central bank did was to actually allow them to actually play in the FM window. Of course, don't forget that when the FM procedure or brochure was released in December 2024, BDC was part of the participants that were listed on that brochure. But what the central bank was trying to do is to actually ensure that they now have the capacity to also play in that segment of the market. And immediately, the central bank found that okay, the 82 has actually crossed the mark. They were actually onboarded into the FM window, although with conditionalities that, whatever you buy, if you don't utilize within 24 hours, you need to sell back to the market. And what the central bank has done is to actually create more supply to the retail end of the market. And because of that, we've seen aggressive close up between the official window and the
parallel
parallel
market.
window. And don't
I
even
think the
sometimes
premium is
during
about
this week,
$30, 30 Naira now, thereabout.
I'm telling you as we speak, it's not even up to that again. Because just on Friday, it was around 1,323 Naira or so at the parallel segment of the market. And the offshore window is also trading around 320 something level as well. So it simply means that one way or the other, it has actually aligned almost close to trading at the same level. And that's what policy would do. Beyond you actually chasing, imagine you forcing BDC to actually sell at a specific rate, sending EFCC to actually chase them across the country, just to watch actually so that you can actually mandate them to sell at a specific rate. Of course, when you continue to use that model, it will not work because there's no way you can actually get them to actually align. So there will also always be downrange seeking opportunity. But actually bringing out policies, great policies, will actually close up the gap, and that's exactly what the central bank has done, and that's why we actually enjoying the result.
And therefore, you forgot to mention that the CBN has actually been in the market this week, majorly as a buyer, which is why the Naira has not appreciated significantly. All right, because
did I actually touch? True, did I touch 1,000? Naira touched 1,311 Naira sometime this week. And suddenly we saw central bank as a buyer in the market. At least the central bank has operated in this market about 3 times this week, where they actually are on the buying side, which is always unusual. You see a supplier coming to the market to be demand for FX. Of course, it's very surprising. But one thing is that that is the core responsibility of the central bank to ensure stability of currency. Yeah, and that's exactly what they are trying to do.
Okay, so therefore, let's bring it all together now. So assuming the MPC now holds rates, or you've already said you expect that they're going to cut rates. What's your near-term outlook for the bonds market? We will see. We're going to continue to see yield compression, more foreign portfolio demands, or do we expect yield to stabilize around this current level?
You see, if whether the monetary policy guys, whether they cut rates or they actually hold rates, the bond yield will continue to compress. We will see 15% very soon. You see, I was okay. Let's look at the month of November. We were trading 15.5. We were trading 15.30.
Yes.
What changed the dynamics was in the month of December when DMO demonstrate that aggressive posture, where unusual. It was unusual for us to see DMO coming to the market 3 times in the month
for those high issuance volumes.
NC bill, and with that volume. So it was that posture that actually pushed rates north. But when you see between then and now, inflation has dropped. When you see between then and now, there has been more aggression to the reserve. So there is no reason why we can't test that level, even when inflation was still, of course, the level where we traded when inflation was still higher than now. So I think whether there's a rate cut or there's a hold, we'll likely see yield to continue to compress. But just the difference will be that the speed of compression is what would differ. So when there's a rate cut, it means that we may see more like a gap. But when there's no rate cut and maybe it was just like a hold, what we'll see is more like we'll see a gradual compression of yield. Because even if there's no rate cut, we'll see more like a forward guidance on the part of the monetary policy guys.
Yeah, which can also be as important as whether they decide to make a rate cut or not. Okay, let's talk about on the equities side too. So the NGX has been on a tear. I think the year-to-date return is somewhere around 25% or thereabout. So post MPC, do you expect the rally to continue, perhaps fueled by easing of the monetary policy, or could we see volatility, okay, if MPC holds firm?
So I think currently equity market is not looking at whether they hold or whether they cut currently. It was more just enjoying the euphoria of the time. it's an earning season. So a lot of people are positioning in that segment of the market. We need to re-rate the market because of the valuation currently. Most of the stocks that were actually undervalued, of course, a lot of them market are actually seeing value and market are actually showing interest as we speak. But just one good thing is that if there's a rate cut, that will further push interest into the equity space because it's simply that people will actually look at it from this perspective of the fact that there will be better dividend yield because when you look at some of these names, you could actually get a better dividend yield than what the bond will actually bring to the table, and also that dropping in rate also will lead to drop in finance costs for some of these companies. And when finance costs drop, of course, that will impact the bottom line positively. So if the bottom line goes up, it means that dividend will be likely actually inch up, and that will also affect investors. So I think that we will likely continue to see interest in the equity market, considering where we're currently standing. And like I mentioned, there are a lot of good names currently in the market. MTN is there, Aradel is there, Access Bank is there, Zenith is there, GT is trading north of 100 Naira now. I'm sure if someone has told you like about 2 years ago, when GT was in the market for their recapitalization,
about
they
45 Naira or thereabout.
44.5, I think it was 44.5 thereabout. And the same instrument is trading over more than over 100% increase from where it was actually offered. You see a Zenith that was actually done at 36, then it tested 90 Naira sometimes last week. So it gives you a picture of where we are currently. And when you look at some of these names, they're actually still very much strong. Like I mentioned, I spoke about the cement sector as well, the potential of the cement sector. And that's one of the reasons why you see some of these companies also expanding capacity because they know that the opportunity is still very much in the country.
Yeah, let's begin to wind up now. So you obviously sound very optimistic about the Nigeria's economy and the Nigeria's market going forward. But are there any key risks that you see, like election, liquidity, any global factors that we should pay attention to?
Of course, we need to. Currently we are now trading a global market, and don't forget there's impact of this contagion effect of happenings across markets. And
Yes.
just yesterday, the Supreme Court actually made their pronouncement around the decision of the President of the United States. And between that yesterday and now, the President has mentioned that he wants to increase the tariff from 10% to 15%. Just to actually, I'm sure that's just to actually show the Supreme Court that he can actually override their decision. And if he actually ended up actually implementing that one way or the other will affect markets. Of course, we've seen that in the past. We've seen how market react to that in the past. That could actually create a bit of panic. That could actually lead to a lot of investors trying to fly to safety. And that's one of the reasons why we're seeing that level of improvement in the value of commodities. When you look at gold, you look at silver, you see the level of valuation they are currently enjoying. And so it simply means that there's room for that even in that segment of the market, because if there's any panic, a lot of people will want to fly to safety. Flying to safety is either flying to into more like the greenback or flying into commodity markets. So for us, we feel that there's still that level of risk that could actually happen, that could actually impact and lead to more like capital reversal. But the good thing is because of the level of reserve we are currently sitting on, that will not be so much a concern. We see that happen last year, April 1st, that was the Liberation Day. We saw what happened in the market when there was a bit of panic in the market, and there was a bit of callback of funds from emerging and frontier market. That impacted the Naira a bit. We saw the currency hinge above 1,500 at the FM window. But one thing is that central bank never panicked. They actually allow market to actually trade, and intermittently when there's actually need, they come to the market to actually supply to the market. And here we are now. We are currently trading like over 200 Naira from where we were there. So I think that there could be that kind of happening, but it's not enough to actually dampen the level of good opportunity that the market's currently presenting.
Yeah, I get you. I mean, we were all here watching that Supreme Court decision. I think the recent 10% tariff that the US president has placed is in pursuance of its own powers, because the Supreme Court actually held that even though that the president can impose tariffs, but on the instrument the president relied upon to impose those tariffs that the president had, and then that's why the president is now using, other avenues available to impose that tariff. And as you mentioned, obviously, we operate in a global market now where whatever happens in one economy would immediately lead to a contagion effect or impact other economies. So, Dipo, in closing, what are your final thoughts for our viewers, listeners? Do you have any tactical advice for them going into this week and even for the rest of the quarter?
Well, for me, I think that there's still ample opportunity for investors in the equity market. There are quality names that they can actually look at. And of course, we've seen pockets of names in the market. And be very careful of bandwagon effect, the heading effect. You need to be very careful. A lot of people at the time were actually investing aggressively into some exchange traded funds. In the market. You need to be very careful, understand the market, understand the underlying asset of some of these ETFs so that you can actually make a very good decisions. And beyond that as well, ensure that you understand the dynamics of why you are investing or where you are investing. Of course, if I call you to invest in MTN, you must be able to ask why MTN. And
Yes.
the person must be able to give you the reason why he feels that MTN sounds more like a very good investment opportunity in the market. And also, the bond market is still very okay. Like I mentioned, the belly of the curve is trading around 16%. But when you look at the long dated instruments, more like the 2053, 2049, 2050, which are more like a 25, 30-year instrument, they are currently trading at 14.2 levels. So it gives you an idea of that. We may likely see more like a normal yield curve this year. So for you to see a normal yield curve, so it simply means that the belly of the curve can also test at those levels. And so if the belly of curve tests those levels, it means that it's for those people that actually invested now. And don't forget, in January, we mentioned something around the 18.47 treasury bill that was
Yeah,
actually issued
we
by
did talk
central.
about that.
And we sent that thing then that the central bank DMO, they are currently doing promo. So it's for anyone to actually key into that promo. So I'm sure if those that actually benefited from that, when they look back now, they feel that that has been one of the best decisions they would have made this year. So there's still opportunity in treasury market. There's still opportunity in the bond market, and also the equity market is still very much great.
It's been a wonderful time speaking with you, Deepo. It's always been my pleasure having you, and thank you for your insightful analysis as always.
Thank you very much, Dr. Tony. Thank you very much. Always a pleasure to be on this program.
And everyone, thank you for joining us today. Again, we are here every weekend analyzing, dissecting the financial markets and bringing you up to speed, giving you insights on what you should expect in the weeks ahead in the Nigerian market. Again, if you are new to this channel and if you've enjoyed this episode, please like this video on your way out, subscribe and share with your community. And thank you, everyone. We are out. Bye.